Good morning, everybody, and welcome to the second instalment of our webinar series at Clifford Chance. My name is Amy Mahon. I'm a partner in the corporate finance practice, specialising in domestic and cross-border M&A transactions. Now, we've seen a recent trend of corporates engaging in lending to other corporates. This is in a large part driven by the environment of low interest rates and low returns on other liquid investments. It's also been driven by retreat of the banks from providing debt finance to certain countries, certain sectors, certain companies, and also certain other forms of finance, such as the capital markets, has been inaccessible for certain companies, such as SMEs in particular. So alternative lenders, such as corporates, are providing much needed liquidity in the market. Now, Clifford Chance has been following this development very closely, not least because of the anticipated regulation of the sector, the so-called shadow banking sector, but also just generally the implications for our clients on this. So today's panel discussion will focus on a few things. Firstly, looking at this trend, who are the lenders, who are the borrowers, what sectors are we seeing this in? Secondly, on regulation, as I mentioned, the impact this may have on those activities. Thirdly, how do corporates manage the risks of providing credit in other ways? We look at some sort of governance issues. And finally, the interaction with the traditional lenders, the banks, how those relationships are playing out. So I'd like to introduce my panel. Firstly, I've got Simon Gleeson, a partner from our finance practice, who specialises in financial markets law and regulation. Secondly, Hugh Jenkins, who is a partner from our finance practice also, with extensive experience in infrastructure financings, both here in Europe and in Asia. And finally, we've got Naren Singh, a partner from our financial institutions group, who specialises in financial institutions M&A. So the format of this webinar is 20 minutes discussion followed by Q&A. This is a live webinar, so I do encourage you to submit your questions, and we'll try and get around to answering as many of those as we can at the end. So let's kick off the discussion with a question to Simon. Some of the sort of more traditional forms of investment and using the cash balance sheets available to Treasury functions are slightly less attractive maybe today. Is the sort of risk outweighing the level of reward? Is that what's driving this activity?
Well, very much so. I mean, banks to some extent aren't what they were. In the old days, I think there was to some extent a belief that cash could be left with the big banks on the basis it would be safe. Governments are making it quite clear that in the future they will not bail out banks. If banks fail, the people who suffer will be their large creditors, which means that if you're a user of a bank, if you have substantial cash balances, you're now really having to get into detailed credit analysis in a way that historically people haven't done. And since those balances aren't offering particularly good returns, then I think those who would normally just have left cash piles in the bank are starting to think, well, hang on, this is not as safe as it was. It's not giving me the returns I need. What are the other options? Now, of course, traditionally, you've always had things like money market funds, which have delivered a higher return, but with some degree of nuisance. I mean, classically, for a corporate treasurer, the problem with holding portfolios of securities and things like that is that you throw some volatility into the balance sheet valuation that you prefer not to have. Yeah. But constant value MMFs, the recent regulatory changes there are making these more attractive. Holding portfolios of safe assets, investing, lending out through collateral and repos, or just using cash sort of elsewhere within your corporate group. There are a lot of options.
Okay, very good. And just picking up on those options, where are you seeing most activity when corporates are going out providing this finance? Who do they lend to typically?
Well, the people they know best, of course, are their own customers and their own suppliers. And, lending to customers is implicit in business. It's just a question of how you expand that in a profitable and scalable way. But, if you take a customer, for example, you may have, you may be a feedstock supplier. The customer may be carrying out some capex. You may want to, lend money to help develop the project, which may develop demand for that feedstock. That may put you in a position where you're having to negotiate into creditor, maybe with other senior lenders or other lenders in the piece. So corporates are having to become more sophisticated in that respect. On the other side, on the supply side, you may have, say, an energy company who is taking oil and gas from a mid-cap company who finds itself is a young company, difficult to access capital markets, bank markets. So maybe the corporate is in some sort of prepayment facility where effectively he prepays for the commodity, and that is a form of providing credit for the suppliers. But there's a lot of variations to it, but we're seeing more and more opportunities here for corporates to use their available cash to augment their businesses with credits they know and understand and feel comfortable with.
Okay, very good. So you mentioned one of the, sort of oil and gas, that sector. Naren, are you seeing this in the financial institution sector or with your insurance clients?
In terms of insurers, let's take those as an example. Corporates have quite a lot to learn, I think, from insurers of how they can put their cash to good use. In fact, corporates probably have an advantage over insurers, because insurers, of course, are heavily regulated, unlike most corporates. Of course, insurers have been in this space for a long time. If you take AXA, for example, which recently raised billions, in fact, through its real estate funds in France and in Europe generally, and the investors in those have tended to be actually insurers and pension funds. Another good example is Aviva. Through its commercial finance arm, it has got billions invested in commercial real estate loans. And also, interestingly, public-private financing. It recently took 180 million participation, or thereabouts, in fact, in the public-private financing of student accommodation in Essex and Reading. Now, turning to regulation, now I've said that insurers are more heavily regulated. They are. The differences between corporates and them is they can only use their policyholder funds for insurance purposes. They're not allowed to engage in lending as a commercial activity as such, a separate business line. So they have to do it through subsidiaries or external companies for origination purposes. They're also subject to quite strict counterparty and market limits in their investment strategies. Under new regulation, actually, under Solvency II, they're going to have more flexibility in what they can invest in. But, there may be higher capital charges as a result. So there is a good competitive advantage for corporates.
Very good. And so just looking at regulation, which Naren has touched on, do you anticipate, higher levels of regulation that will impact this sort of activity by otherwise unregulated entities?
Oh, very much so. I mean, really the concomitant of the increase in regulation on the banking sector has been a focus by regulators on the circulation of credit outside the banking sector, simply because the view is that if all that happens is this business moves from the regulated to the unregulated space, then really nothing very clever has happened. The thing is that lending, the creation and transmission of credit, historically hasn't been a regulated activity in itself in many jurisdictions. It is in some, it isn't in others. This is one of the last great unharmonized areas of financial regulation. And there's quite a lot of thought going on at really the high level, because for regulators it's not intuitively obvious that this is an activity that necessarily needs to be regulated. It's more a matter of what is it exactly we're trying to control here. And of course, the thing that makes it even more complicated is that the vast majority of people who want to take on credit exposures may not want to become credit analysts and take exposures one by one. They're more likely to want to take those exposures through various forms of pooled vehicles. I mean, Naren's funds are a perfect example, but certainly CLOs and credit funds exist pretty much for the express purpose of sort of de-risking, if you like, or taking away the credit analysis element. There are also sort of business-to-business networks, which again enable sort of broader lending. Secured, if you are lending, you can remove your credit risk through secured financing repo techniques. And interestingly, what we are seeing is that bank regulation tended to push bank secured lending down one particular route. When this lending happens outside the regulated space, you start seeing sort of forms of certainly things like trade finance, forfeiting, all sorts of odd things, are slightly coming to the fore now that it's non-banks looking at doing it. So there's a lot going on.
Okay. Yeah, I mean, you mentioned credit funds, and I do a lot of work with private equity funds and infrastructure funds, and many of those, likes of KKR3I, CVC, EQT, they all have sort of debt arms engaging in this. They themselves are managed by regulated entities, so there's protection there. You've got AFMD, which will be in force in July, which provides a further layer of regulation. But of course, the fund terms themselves provide a lot of protection, so you don't have the risks of sort of runs on money from a borrower perspective, because investors are committed for a fixed period of time and there are sort of limited gates. There are strict limits on leverage levels, and from an investor perspective, they don't end up with sort of unexpected exposures, because policies are very clear and there's a lot of transparency to information. And I guess same point on insurance vehicles, that there's a certain amount of protection inbuilt in the regulation there. Are there lessons then to be learned from that for other corporates who aren't maybe now and regulated themselves? How can you manage the risks associated with providing credit to third parties?
Well, again, insurers are a good example. Although corporates don't or aren't as heavily regulated as insurers, the board still has a duty to act in the best interests of its shareholders, and also, there needs to be a corporate benefit for the company to enter into these transactions. And so the corporate still needs to have a certain level, obviously, of expertise, whether that's internal or external, to make sound investment decisions. Yeah. Insurers have the larger insurers have very sophisticated risk mitigation techniques, quite tight investment strategies, the counterparty limits I was talking about earlier. Yeah. They also have governance processes, and we're talking here about systems, controls, strict reporting lines internally to make sure that every level of management is involved in decision-making processes, particularly for investment strategies. So corporates can look to mirror some of these, albeit in a less prescriptive manner, to manage their own risks. Also, just turning to ratings very quickly, because I know we haven't mentioned that in particular amount of detail. People, or insurers in particular, have tended to rely on ratings in the past. They are still useful. Obviously, rated instruments, rated securities are going to be less risky than unrated debt. But given market volatility, and the amount of downgrades, whatever, upgrades after that have happened recently, insurers are looking for more stable investments, and I think they're looking for better security. So collateral involved in real estate debt, for example, is better for them, has better capital treatment.
Okay. And Hugh, are you seeing that in sort of a broader context?
Sure. As corporates develop the lending business, they're going to be faced with this issue about, the need maybe to form a separate subsidiary to carry on those activities. By its nature, that is a business carrying on a lending business, primarily a lending business within that company. They've got to comply with, Simon's talking about some of the regulators looking at some of those activities in maybe, some of the shadow banking forms. Maybe there's some consumer credit, regulations they need to, look after. But tax, we haven't mentioned tax yet. It's an important, that subsidiary be incorporated in the right place. They'll be receiving interest income, which obviously is different from maybe some of the other sources of income. So there are a lot of things which a corporate would need to think about in terms of, which level of regulation does it want to go for, what business does it want to go for. But, Simon was mentioning earlier on, I think the biggest challenge for really is the credit challenge, to move beyond, customers, suppliers that well. Yeah. And then how do you take those credit decisions? Do you rely on ratings, which, we've had similar examples of rating cliffs in the past where, where rating changes and everybody moves in or out. And, Simon's quite right. The portfolio effect of having more CLO type investments, I think, is very helpful to a corporate looking to broaden beyond that base.
Very good. So if non-bank lenders and corporates are becoming very, very prominent, do you think that's potentially the end to our banks? Should banks feel under threat?
I'm a banking lawyer, so actually I hope not. No, I think it's it's a mutually beneficial to partnership in many ways between the corporate and the bank. The corporates don't necessarily want to become banks to do all the things banks do, all the administration, There's a whole lot of things, derivatives, all the things that go with transactions that banks would be doing. There's a lot of expertise in banks to do that. I think on the arranging side, where banks do, obviously earn income from that part. I mean, if you've got some of these large insurers, I'm sure they're looking potentially to self-insure, self-arrange their business, and maybe ask a bank to front it in a way in a jurisdiction where maybe they haven't got the right licenses to do it. But overall, I see it as a mutually beneficial arrangement.
Yeah, I guess certainly in M&A context, banks will tend to lead the syndicate and bring in the sort of corporates later. Yeah. Okay. Well, I think we're receiving a large number of questions coming through, so I might put some of those to our panel. Narend, we have a question about the structured finance products that you mentioned very briefly at the outset. Would you like to elaborate a little bit about what you're seeing there?
Yes. I mean, I mentioned earlier, public-private financing, and you mentioned acquisition finance. The products that we're seeing are actually structured finance insurance products. They're not so much an insurer investing in a senior secured, commercial property loan. And the reason why there's a gap in the market, and the banks are also retrenching in these sorts of products, is a lot of banks are no longer prepared to take on the risk of, borrowers with light balance sheets defaulting on collateral obligations. So products are being structured as insurance products to replace the banking products, that operate like letters of credit and bank guarantees, to cover that risk. So taking on, to cover those sorts of products that other banks would have provided to project banks in the past.
Okay. Another question we have probably for you, Simon, is on regulation. And just whether you're anticipating an increased harmonisation of regulation across different territories?
Well, I mean, harmonisation of regulation is probably never going to happen completely. Different regulators worry about different things. So I think what we are going to see is a sort of broad agreement at a global level about how to think about non-bank credit. But it's very unlikely to make the cross-border world seamless. We'll have cross-border problems forever. But that's having been said, money is the easiest thing in the world to move around internationally and across borders. It really is. And so to that extent, I think what's going to happen is we're going to see this market developing in real life. I think we're going to see regulation following along behind, possibly quite a long way behind. And as is often the case with these things, the most prominent driver will be the operation of the law of unintended consequences. So I think what all that takes is this isn't an area that's going to be regulation-led. Nobody's doing this in order to take advantage of regulatory developments. Regulatory developments will very much follow the column rather than lead it. But I think there is going to be a trend towards harmonisation in the long term, but don't wait for it just yet.
Okay. So we've had two questions. This is probably for Hugh. So just looking at non-bank lenders from a borrower's perspective. So one asking if a non-bank corporate lender is very different to a bank. And secondly, if we're seeing corporates buying slices of syndicated loans, and how do borrowers react? So sorry, a two-pronged question for you there.
Well, the first one, I think, from a borrower's perspective, borrowing from another corporate, I think just very situation dependent. I mean, if you've got a need for money, an immediate need for money, the corporate is, available to lend it to you. You agree the interest rate, you agree the basic terms. There's very few downsides from that relationship from a corporate perspective. In the sense that its analysis is a little bit like the capital markets analysis. The market's available, the pricing's right, the term is right. Why not go and take it from the corporate, just similar to the capital market. I think where the banks have advantages in terms of a corporate relationship with the banks as a corporate as a borrower would be, well, what if it doesn't need the money now, or it needs a guarantee, or banks are by their nature are technically open for business. So, whatever you come in with, they're in a position to lend you money all of the time. Whereas a corporate, will depend on its treasury, depending on, what it chooses to do with the money. I should say in relation to the general picture, though, that I think the bank markets have done a lot to help corporates get into the market, because you've had a lot of standardization of loan products over the last sort of decade or so. You've got the Loan Markets Association. There's lots of publicly available standard forms. So the document you can put together as a corporate lender will not necessarily look too different from what the borrower might expect from a bank lender. The banks, in a way, and the Loan Markets Association have done the hard work for the corporate in terms of the learning and the intellectual property, if you like, that goes into that business. So I think that helps a lot. I think you've asked me in terms of the relationship between banks and corporates as co-lenders. There's no issue. I mean, if the loan's being made, then a lot of corporates will take secondary participations in those loans. To some extent, it becomes an issue more for the borrower. Does it change the tax position on the loan? Is it, you worry about competitors taking an interest? Are you worried about the market knowing who are these lenders going to be? Are they going to be more interested in your business because of other reasons, not just because of a lending reason? You do have some quite interesting situations there where you have, say, an ExxonMobil goes and lends a big chunk of money into a petrochem project maybe and says, I want to be a senior lender. And maybe the other lenders will accept that, and they'll say, okay, that's a great way to build the balance sheet for that project, but they won't necessarily agree to have the same decision-making rights for that entity coming in, who's maybe got maybe, as I mentioned earlier, a feedstock supplier. So maybe same level, but the decision-making being more the class of lenders who are real lenders into the project.
I guess the other point is, in a distress situation, certain lenders will react quite differently. So sometimes borrowers are quite focused on the identity of other lenders. Okay. Well, thank you for all of your questions. I think there are a couple more which will respond to people directly to the extent we haven't been able to pick up on them here. To sum up then, we've looked at sort of corporates and the activities and the drivers for why they're engaging in the provision of finance to third parties. We've talked a little bit about regulation of that activity and its harmonisation or otherwise. We've looked at the importance of managing that risk in other ways, and governance and proper structuring. And we've also talked about banks continuing to have an important role. I would like to ask each of my panel members to for their key takeaways in a matter of seconds rather than minutes. Starting with you, Simon, what's your key takeaway from this discussion?
I think the key takeaway is just that the world is changing, perhaps faster than we think. And in this particular area, who supplies credit, who provides credit, how is it intermediated? I think the world in a few years' time is going to look very different from what it looks today.
Very good. And Hugh?
Well, I wouldn't get too depressed in a way by all the changes in regulation. I think the real economy has an absolute need for corporates, insurers, funds, everybody to look at this market. And for everything we've heard from regulators, they are taking quite a positive view on it. And I wouldn't sort of wait for the regulations to happen and then think about going into it. I would, in a sense, if you see real opportunities, put your foot in, and then allow the regulators to develop the strategy around you. We've seen with peer-to-peer lenders, who are an absolute new. Somebody in the market, they're looking to shape their own regulation around them. So I definitely think there's plenty of room for those sort of players to come into the market today.
Of course, we'll advise them on how to move that forward. Narend?
Well, I agree with Hugh. I'm going to take an optimistic view. I think there's a lot of opportunity for corporates out there. I think, I've mentioned there are people out there that can be used as examples for corporates to, manage risks, etc., put in place good procedures, and for their investment strategies, obviously. I think there's probably going to be more opportunity for corporates. We need to look out also for, additional layers of shadow banking regulation if insurers are going to be classed as systemically important, like AIG and Prudential and, MetLife just have been in the US. So, there's a lot of opportunity now and going forward.
Okay, very good. Thank you very much to our panel, Simon, Hugh and Narend. Thanks very much to you to tuning in to this webinar. Our next webinar is on the 20th of June and it covers emerging trends in M&A. Thank you very much and goodbye.